Hello, I'm Robert and welcome to my channel where I talk about everything automated algorithmic trading or simply algo trading. We've seen this spreadsheet before. It's one I use frequently, but now I'm going to demonstrate why it's so important. I've talked about this before several times in terms of why these numbers are so critical. And after careful testing and proving them, I'm going to show you how this really works and why it is so significant that you follow this practice. And I'm going to do that with a couple of screenshots. First of all, here is my current account standing, and there are a few numbers to really pay careful attention to. The unrealized P&L is very critical, and I'm going to demonstrate why that is in a few minutes with the spreadsheet. And of course, my current holdings. Now, here on this particular screen, I talk about the necessity of getting your unit sizes correct, and the way is trial and error. Now, what I've done is I've played around, and you'll see I've chosen 746, which is my highest level of my current settings. And that leads me to a margin usage of 1633. And that is based upon the price of 10944. So these numbers are important because if you look up here, this table shows those numbers appropriate. This table, the blue, shows the numbers based upon the maximum of $2. So if I put 10944 here, you'll see that the numbers now coincide pretty close to what each of the tables show. Remember what I said, though, from the very early on point of this table. Use the worst case situation as your metric, because one thing that you have to be aware of is if you can match this, meaning if your worst case situation falls in line with a profitable situation, then your real values will always lead you to a safety zone. And this is where the unrealized profit takes place. So minus 313.66. Right now you see I'm not using that at all. I'm using only the usable amount of the cash. But you have to count your unrealized because it's deducted from the usable amount. So minus 314. I'm just going to round up for convenience. And now I'm going to come over here and do the same thing. And we're going to see just how much this changes. And it's important to pay attention to why these change. Notice here, we go negative on the 15th position. But really, because of the actual numbers, the actual worst case that oanda calculates, we are perfectly safe. So even though our worst case situation is in trouble, our actual balance is not. That's why you need to be precise in your numbers, and why you need to actually use the worst case as the blueprint for your actual, because this helps you actually figure out what you need to adjust in your spreadsheet to get the perfect values. So by doing this, by actually taking the worst case and then comparing it to the real values that oanda gives you, you can see clearly the differences and just how much extra padding and safety you're building into your account. That is critical because, as you can see, I have still $599 of margin left. Even though this shows I've blown the account up, the bot's going to stop automatically as soon as it can't get a new position. It's going to stop dead. So it'll stop dead on this number, meaning it won't purchase anymore, but it will wait for a sell opportunity. So by doing this, I have roughly $600 left just waiting for emergencies that the bot can pick up on when it sells a position. But if you look over here, the actual pricing, the actual numbers, I have plenty of space. All of this sloppiness deliberately makes sure you avoid a margin call. And I call it sloppiness, but it's really not. It's just additional padding to ensure that no mistakes are made along the way. Kind of a cross-check between your mathematics and what the bot is actually going to do. This is a defensive technique that really lets you optimize your choices. Because if you do something wrong, let's say, as you've seen in my shorts where I tried units of 1400. What happens? Well, it turns into a hot mess. Even though it says here it's going to work, it actually doesn't, because you don't have the balance because of the unrealized losses. That's why that number is so important to pay attention to, and why the blue table really is the metric you should be using. So let's see what it takes to get the blue table in line with the lavender table. So we had 746. So let's go down to 735. Okay, well, 635. How about 600? We're getting closer. How about 500? So you see, you can actually use this information to help you tune. But because I know for a fact my own risks will allow me this type of a situation. Again, I've tested this in a demo account. I'm comfortable with this situation. But if you're not sure or you're just starting this technique, always keep track of your unrealized profits, add it in, factor it, and think about it. Because the bigger your position, the bigger your unrealized profits are going to be, or unrealized losses. So it's something that you need to be aware of. This is absolute safety. It's easy enough to put this in. It's easy enough to build this table. All it is just taking the numbers that you already have on this table and simply deducting what your margin rate is for each position of the highest level units. That is your ending units. See, I could calculate margin for every single position, but I want that worst case scenario baked into everything. Every single detail, I want that worst case scenario. And as you see here, 1692, 1633. As we change and go up, you'll see $20. But this 1633 is on the basis of 746 units. So if I were to go back to oanda and type in 400 units, it would give me about $8 per margin required. So you can really see just how critical these numbers are and why you should take your time to understand every single one of them. This type of system is what helps make sure your account stays safe. Because once your balance goes to zero, the bot will automatically stop purchasing. Or specifically, if your account balance is less than the actual position size it wants to purchase, it stops until it sells off or until a stop loss is triggered. So this type of an approach is a safety. It's a blueprint to protect your account first and foremost. And you can change drastically different numbers to get the different results you are looking for. One of the things that you'll notice is I have based everything on 23 levels. That is comfortable for me. That may not be comfortable for you though. You might want more or less based upon your budget. But the thing you want to be aware of, if you are having too many stop losses, then you don't have enough levels to handle basic market fluctuation. Too many levels and you're paying unnecessary finance charges. So trying to find that happy medium is kind of trial and error. Use the demo accounts. Remember, you have 60 pairs to try and you can have a large number of accounts. It's very easy to set up as I did, 4 different accounts with the same pairs and different settings of each one to see which ones work best for which situation. Match them carefully to your own trading. No matter what, you must protect your initial budget. Your initial balance must be protected. And as you can see from here, versus what this shows, Euro USD took quite a few stop losses today. No surprise. This is also part of the thinking process. You need to think about your stop losses. You need to think about how that plays into the system. So right now my budget is $13.97. And you'll notice my numbers changed. It's important that you are aware of those circumstances. Again, remember, this is based upon 476 units. This is what my account actually sees based upon $2. 109,445. 1.09445. I got an extra 1 in there. So now you see the margin close to the one in the lavender. And you see it works out. A little bit of room to spare, but it still works out. Take the time to make sure your numbers are consistent. Take the time to double check everything, Because if you have everything correct, you have examples built into the system automatically that will hedge against losses. The bot will automatically trigger at levels necessary to shut down and stop spending. That is the most important factor of this entire process: asset protection. Take the time, run through the Oanda app, run through the process, figure out your units, figure out a desirable stop loss. I look for about 50 cents per trade as a good and reasonable level of profit. If you're more risk adverse, you might want to try 4 or 3 pips for a take profit and then see how that affects your unit size. Remember that smaller profits happen more rapidly than larger profits. A larger profit takes longer and automatically incurs more risk. So if you don't have the risk appetite for 7 pips, you could easily go for 25 cents per position at around 4 pips. Nothing wrong with that. Or roughly 3.5 pips. And that will give you a good, comfortable margin. Everything in this process, everything in this spreadsheet is designed to mitigate risk. This is the actual position value right now with my leverage. But because I factored all that into all the numbers above, I'm not worried about this closing out because it's been set such that I have a very generous boundary that I have to worry about. Or I should say that I don't have to worry about. Even with this situation, I'm only using 22%. I am not even halfway exhausted my allowable margin point. That's where you want to be. You want to be in such a way that you never need to worry about a margin call, let alone a margin close. So hopefully through looking at these tables, you can see just how easy it is to really plan and think about your numbers. Now remember, this should be less. For example, let's go down to 400. You'll see that the margin really is significantly lower. So if you base everything properly, you can see just how different the numbers really behave. And that is how the bot really looks at the market and your position dynamically and makes decisions based upon real-world market data as the market changes and moves. Just like my bot did today, and taking several stop losses. One, to protect the main balance, and second, because the market moved aggressively. Both of which are factored into the calculations, and both of which are obvious when you look at those factors. Build this spreadsheet for your own trading. Use it. Practice it. Make sure you never go above the usable amount. If you trade 4 pairs, then each side will be 25% of your balance. Keep these numbers accurate, but keep them overinflated at the same time. Meaning, think about your worst case situation. Because if your worst case situation happens, you still have a chance to function. So even in the worst case situation, I still come out on top. And that's the whole point of why this works so well. Practice heavily with the demo accounts. Put this into practice. Whenever you make a change, check the numbers first. Always. Check everything, because without it, you may end up in this situation. Having the blue side whacked out is fine, because this is overkill. Having the lavender side whacked out, this is liquidation. This will guarantee you wipe your account out. Check, double check, recheck. Don't just trade or set this up without verifying everything within your risks, because in doing so, it will lead you to ruin. The road to success with this kind of a strategy is aggregated consistency. That aggregated consistency works in small amounts, whether it's 25 cents, 50 cents, or even 2 cents, if you're only using a budget of, say, $130. And yes, this technique does work on a budget of $132. As we can see, let me take out this number here. I'm going to fix this one even though I don't need to. The blue table calculates everything in real-time worst-case scenario. So we can see with just a small $132 account, it works. It will work consistently, it will work reliably, and it will work defensively. That's the whole point of why a floating grid technique is so valuable. It moves with the market. It functions with the market in a way that protects you as the market flows. Traditional grid techniques don't. You will lose money if you practice them. A floating grid technique, as I have demonstrated, always works as long as you follow the principles exactly and concisely. And if you're using automated trading like the programs I've built, then this is what the programs do automatically. All you have to do is just make sure you put your numbers in correctly. For example, let's see if we can maximize our budget. So on a $132 budget, you could trade 57 units. Your worst case is going to be 80 units, and that is what this table is based upon. You're not going to profit a lot with each trade, but you're going to aggregate those profits over time, as I have shown in many of my previous videos. This is what trading is about. Slow, consistent, meticulous steps. So hopefully this has helped prove why these numbers are so critical, and how to use them, and how to also determine the most important processes, like figuring out what unit size you should use. Oanda is one of the better brokers for this. It goes out of its way to provide you with a great deal of information to help you keep from losing money. The sad truth is, 78% of all oanda subscribers don't use this information correctly. They don't practice safe and reliable trading techniques, as I have demonstrated here. That is the most critical point of why you need to follow this basic system. Don't become 78% of the losers. Stay within the 22% of the winners by practicing this technique over and over until you can do it in your sleep. If you can't do it manually, then you're not going to understand it when a bot does it for you. And that is a recipe for disaster. Let me know in the comments if you have any questions about any of these equations. They're very simple, but they still can be confusing when you see them all put together. Like and share this video with people you know if you think it will help them. And thank you for watching. Until next time.